Good afternoon. Maybe good morning to those of you in the West Coast. Looks like people are filing in here. We're expecting a good turnout today. So today we have the big beautiful bill, our OBBA. Either one, say that 3 times fast, or better yet, let's just start and get down into it today because I think that's a mouthful. So first we'll look at key deductions and credits that they affect not only compliance, but also your organization's financial planning. Next, we'll discuss adjustments payroll teams need to make. As these changes roll out, proactive adoption will be your ally in ensuring ensuring seamless operations. And finally, keep in mind that some areas still need clarification with this beautiful bill. So staying flexible and up to date will be key as new guidance comes out. And I'll share some helpful resources at the end of the presentation that will hopefully make this easier for you to stay on top of things. So this agenda sets the stage for a deeper dive into the core payroll and tax changes coming out in the next year, 2026. Polling question. Is your team prepared for the impacts of the big, beautiful bill? All right, it looks like most people are unsure, and not really, and I totally understand as it's in flux. All right, we'll end that. And next slide will be the bill locks in several provisions from the 2017 Tax Cuts and Jobs Act. While most apply to personal income tax changes, like adjusted brackets and deductions, they will directly impact paycheck calculations and withholdings.
One of the big changes was the increase in standard deductions. So at the beginning of the calendar year, a single person or married filing joint, or single, their standard deduction was $15,000. So now, based on the new regulations under the big beautiful bill, it is $15,750. Married filing jointly and qualifying spouse started out at $30,000, went up to $31,500. Had a household started out at $22,500 and is now $23,625. If you're over 65 or blind, that $2,000 remained the same. What is different is that extra $6,000 for individuals over the age of 65. It is age-based. It is not based on whether you're receiving Social Security or not. That extra $6,000 is capped. So, but it starts to decline. If you are filing single at $75,000, any income over that $75,000 will be times by 6% to reduce that $6,000. So say your total income was $80,000, that's $5,000 over, it'd be 5,000 times that 6%. So for $300, you're going to lose of that $66,000, so it'd be $5,700. If you're filing jointly, that cap starts at $150,000. The tax brackets. So these tax brackets were established during the Tax Cut and Jobs Act. They have been made permanent based upon this new bill. The dollar amounts associated with each one of those percentages remain the same for 2025, and going forward to 2026 and going forward will be adjusted annually with the inflation factor. So in 2026, more people will fall into the 10% bracket, and it'll just filter down through.
Wow, that's a lot of information. So let's talk about how your payroll and HR teams can effectively prepare for these changes. First, it's crucial to review and update the payroll tax tables for 2025. This will ensure that all calculations are accurate and compliant with the new regulations. Laura, what would the next steps be?
So you want to look at what is currently with your payroll. Are the tax tables for 2025 set? As of right now, I have not seen where the tax tables are going to change. At least I have not seen any direction, information on that. What's changing is that standard deduction, how it affects those tax tables. You want to be able to talk to your employees, communicate how these different changes will affect or could affect their take-home pay. Have them look at the W-4s. If they're using lines 3 and 4 on their W-4s, any one of these changes could impact how they want to possibly modify the numbers on those lines 3 and 4. 3 being where you're capturing credits throughout the tax year versus at the end of the year when you file your 1040. And 4, one of them is, hey, I think I need more coming out. But the other one that could impact based upon this new regulation is the itemization. So you want to talk to whoever is your payroll vendor. Hopefully it's Greenshades. And see if they're ready for all of these. Obviously, no one is ready just yet because the final regulations have not been published.
Okay, so one of the biggest payroll related changes in the bill concerns tip income.
So everybody heard no tax on tips. So everybody could have made, or anybody, I should say, could have made the assumption that no matter how many dollars they earned in tips, it's not going to be taxed. It is capped at $25,000. It does not matter whether you itemize or not. It is applicable to traditional tipped rolls. The IRS has made a stab at this as hospitality, restaurant, beauty salon, those type of individuals who they classify as traditional tipped rolls. So you should have already been tracking your tips so they fall into box 7 or box 8 on the W-2. If you're doing box 8 where you're allocating your tips, who are you all including in that? Are you including the kitchen staff? Some places do because they're part of a total product that's presented to the customer. Depending upon how the IRS regulations read, they could be included in those traditionally tipped roles. You could say, well, how is the IRS going to know? On every 1040, a required field is what is your occupation? Depending upon how that employee fills that occupation field out, is it just going to be a generic hospitality? It'll probably be accepted as a viable tip. If they say cook, it may not, depending upon how the regulations read out. This is retroactive back to January 1st and is scheduled to end at the end of 2028. The IRS has provided some guidance on this, what you see here, but not the full thrust of everything. They're supposed to be providing some guidance to you, the payroll administrators, as to how, if you haven't been tracking your tips, how do you go back to January 1 and determine this? They're supposed to come out with that by October 2nd. And hopefully they'll come out with it sooner than that.
But in the meantime, Laura, what can the audience do to prepare?
First of all, you should know as a payroll administrator whether you're tracking tips separate from your regular pay. And I would hopefully assume that you're doing that simply so you can filter in box 7 and 8 on the W-2s. If you are not, you're going to have to try to come up with a methodology. And the IRS is supposed to, the fourth bullet there, give you some guidance on a reasonable method to take that back to Jan 1. You want to educate your employees that are tipped employees that there is a cap of $25,000. And it's only going to affect your federal wages, not Social Security and Medicare. Right now, as I had mentioned earlier, the roles that are definitely tipped roles would be your beauty salon services, your hospitality workers, those individuals.
Hey, how would people handle tips for part-time employees that are also full-time students?
I'm not 100% sure, but I would say, you're reporting wages earned, you're reporting tips. The tips will show up somewhere on not only their pay stub, but on the W-2, depending upon what role, are they employed as an intern? There may be some factors determining whether that income is taxable or not, or would they be considered like a statutory where it's only taxed with Social Security and Medicare or just federal. So depending upon that role that employee has, who's a student, there's a lot of factors that could go into it to make that determination, but the tips, depending, if they're in a tipped role,
Or it sounds like maybe they're just serving tables over the summer.
they should be able to eliminate the tips on the federal income tax up to 25,000. The other big thing was the no tax on overtime. Most people think of overtime as time and a half of the regular rate of pay. That's not the case here. So the regular rate of pay for those overtime hours will still be taxed on the federal. It is that overtime premium, that 0.5% premium, that is the qualifying overtime for exemption. So this is going to be capped at 12,500 for a single person and 25,000 if they file a joint return. There is no clear ruling yet, and I say yet, on if both of your taxpayers on a joint return filed together, if one's tipped and the other one isn't, is that one who may have gone over the 12.5 allowed to go into the other person's up to the 25,000? We don't know yet. Somewhere on the W-2, these are going to be showing up likewise with the tipped. In addition to box 1, they haven't provided us guidance on whether I figure it's going to show up in box 12. That's where the IRS sees it. They may put it in box 14. The federal government doesn't look at box 14 when you e-file, so I don't think it's going to be there. This is retroactive back to January 1 also. But because it is overtime, and if you wanted to determine that exempt amount, if you were doing the full hour or 1.5% of the regular rate of pay, you should be able to take a third of that amount.
Do you know, will Greenshades be making any updates to our timesheet portal for the overtime rule?
I'm not 100% sure. That would be more the payroll piece, how they're going to manage it. And there is not full guidance on, some of the states go, if you work over 8 hours, there's overtime. So is this going to be based on, 40 hours overtime, or the state, sometimes the states get very specific on how they calculate the overtime. So traditionally, your time is kept, you physically work so many hours, and if it's the traditional 40 hours, you work more than 40 hours, those hours over are tracked separately to calculate that time and a half, unless you're a fully exempt employee. So your salaried non-exempt employees are going to be entitled to overtime if you're tracking it properly. Hopefully that answers your question.
So it's crucial to separate and label qualifying overtime hours on your payroll system for accurate reporting, even though we don't have full clarity on how this will be reported. Do this to be prepared for whatever comes. So if we don't have clarity on this, what can we do in the meantime, Laura?
You can try to go back and number one, you want to make sure you're tracking the overtime separately. That is where I would start first. Like I said, if you do it at the time and a half, a third of it is going to be that overtime premium that will be exempt. The guidance comes out usually in the form of IRS quick alerts. So if you have an opportunity or you are not receiving the quick alerts, I would subscribe to them. They come to your email, and you can choose to do it daily or weekly. I do it daily, but they would be providing hey, this is available now, and you can look up the the new rules. As of this point in time, there should not be any retroactive reporting. There is no, it shouldn't affect. Well, no, I back up because it could affect your 941s. So we have to wait until there's guidance to see if we're going to have to correct or amend the first 2 quarters of the 941s because that federal taxable wage. The other one is, you have to make sure your employees understand it's just that 0.5% premium that is not going to be taxed. And it's capped at the 12.5. But like I was saying, if you're filing jointly, I don't know exactly how that 12.5, if they're allowed to exceed that if the other taxpayer on that return is not filing. That's not clear yet. So until full guidance comes out, you can start preparing by making sure you have your overtime separated out and educate your employees.
So, Laura, it sounds like there's some credits and changes for workers that will impact their payroll. Can you tell us more about those?
So the top one there, the transportation fringe benefit for the bicycle fringe, in the Tax Cut and Jobs Act, that was a taxable fringe. It has been made permanent as taxable. The parking and the transit passes remain exempt, and it is at a $325 amount per month for 2025. The child tax credit, this is something that they could include on their line 3 on a W-4. So it was set at 2,000 and went up to 2,200. This is where it gets a little tricky if they want to put that on their W-4, because the 2,200 is fully available to them if they have the tax liability on their 1040. So this amount reduces their tax liability. If they don't have a tax liability, it becomes a refundable portion, which is only at 1,400. So some caution when you're educating your employees, if they want to modify their W-4 to capture that savings throughout the year versus at the end of the year, how they want to fill out that line 3 for that particular credit. The child and dependent care tax credit, so the limits have increased and it's now fully refundable. It's not used to reduce your liability, it's refundable, which when the calculation is completed, and I believe this is on Form 2441 for the individual, it will be fully available to them. The bottom one, the state and local tax, which they call SALT, went from 10,000 up to 40,000 under this bill. Going back to that first slide, we went over the standard deductions. There was no standard deductions that was over 40,000. So if you're in a state that has really high taxes, and in addition to maybe local taxes that possibly is going to exceed their standard deduction, they may want to itemize. And if they want to capture that during the tax year versus when they file, that would be on line 4. I think it's line 4A.
This is where I wanted to sing salt, salt. Where's the gosh darn salt? Okay. I'm sure the looming question is, how does this affect your team? How can you prepare?
So again, going back to the W-4s, if the employee wants to capture those savings in the tax year, they would adjust those lines 3 or 4, or both, however it plays out. But the caution should be addressed there. And they should know based upon their prior year filings, whether they would, be entitled to, if they have a tax liability, and want to take advantage of that child tax credit. The other one to the right of that is the DCAP, which is the Dependent Care Assistance Program. You would know if you, the employer, was offering that program. This amount would show up on line or box 10 on a W-2. It is capped at 5,250, I believe. No, it's capped at 5,000. Or they can use the Child Dependent Care Tax Credit. They can't do both. If they're savvy, they can look and see which one benefits them the most. So the DCAP reduces your tax liability on your paycheck. The other one would reduce your taxes on your 1040. They can't do both. You want to make sure your bicycling commuting fringe is still taxable. So there's many parts to this bill. You want to make sure that you got all the right pieces lining up to what would be reducing tax liability, how it's going to affect your W-2 and possibly your 941. So At this point, we're not 100% sure how the IRS is going to provide us with the guidance on this. But be aware that there's, these are potentials that are going to have to be addressed in the very near future. We just have to wait for the IRS to provide us that guidance.
So I know you deal with this stuff all day long, Laura. Can you give us a summary of the recent legislative changes?
So the most recent are the 3 items listed here. With Tax Cut Jobs Act, it removed the moving expenses for everyone except the military. And then, there were certain requirements were there. Now, in addition to the military, it is including the intelligence community. So you'll know, as a payroll provider, processor, whether you have any employees that qualify as the quote unquote intelligence community. The 1099 NEC and miscellaneous forms will remain at 600 for the threshold for 2025. 2026, that will be going up to 2,000. And then thereafter, it's supposed to be adjusted by inflation. Then we have that wonderful 1099K. They tried to lower this, and then they went back. They lowered it, went back, lowered it, and went back to 20,000. They finally determined earlier this spring that effective January or 2026, it was going down to $600. Then boom, this tax bill, it's back to the $20,000 or $200 transactions for 2025. So that one you have to go back in and adjust your thresholds. Make sure you do that. So these are some different, reminders. Update your systems when it's, monitor the changes and the effective dates of those changes. So right now, you'll be adjusting the 1099K to 20,000 or 200 transactions if you're in that community reporting on a 1099K. If you have employees who qualify as intelligent communities, they're moving from point A to point B, following all the different regulations established for that. The moving expenses need to be reported on the W-2. So we have lots of moving parts, like I mentioned before. Different credits changing, the amounts changing, overtime, tips, 1099 issues are changing at different times. So be aware, be cognizant, just be aware, can't say the word today, of when these changes are being implemented and the amounts that are being implemented.
So so we're getting into the tax credits and benefit incentives. Can you share more details on employer tax credits and the benefits-based incentives?
So these are on the corporate returns. So this is not payroll, but payroll is involved in these tracking of this information. So the paid family medical leave, which was in the Tax Cut Jobs Act, is now made permanent. It has increased up to 12.5%. It also includes the state and locals that enforced the paid family medical leave programs. And the wait time on the employee went from 1 year down to 6 months. So that is something that you can look at if you are implementing a paid family medical leave, especially if you're in a state that requires it. The employer child care credit. Do you have a daycare on site? Do you manage that? The amount went up to 40%. If you qualify as a small business, it's up to 50%. The dollars on those are tremendous. For a standard business, it went up from 150,000 up to 500,000. And if you're that qualifying small business, it's up to 600,000. So if you are operating that childcare on site, take a look at this. The student loan repayment exclusion. So this was a part, this was in the past, it's but now made permanent. If you, the employer, are assisting your employee to do a student, repay their student loan, you can classify that payment up to $5,250 as an educational expense. So that would help your taxes. The employer provided meals through the on-site facilities. Now, there's certain criteria that have to be met, but if you do meet them, you can deduct 50% of the cost.
I know we're close to the end. We will keep going as we have about 5 more slides to go through. We also see a bunch of questions. We will individually answer those questions in follow-up emails for you guys. I know there's a lot of curiosity about how to handle different scenarios, but in the meantime, how do you prepare? What can your teams do? They can check for eligibility for new or expanded credits. You can confirm programs, meet wage and service thresholds, partner with benefits to optimize tax savings. Am I missing anything?
I think you got it for
Perfect.
what we're looking for right now.
Okay, so as we think about everything Laura just reviewed with us, you might want to start thinking about if your payroll system is ready for what's coming ahead, especially of those of you on GP. I saw some questions in the chat about how Great Plains would handle this.
So there's questions that you have to be prepared to answer. Can you separate your tips and overtime income? The jurisdiction specific deductions that would relate to the SALT, the state and local. Can you or do you have the ability to adjust your thresholds? And I want to just stick this one in there. It's not a part of the big beautiful bill. Make sure your Social Security wage base is also updated for 2025. But you're looking at the 1099s, how they're going to affect and everything, and how the IRS is going to handle the increase in standard deductions related to the tax brackets. Your benefit modules. Are you going to look at the dependent care assistance program? Would that benefit your employees more? Is that an avenue for you to retain employees? Do you have a leave program? Are you tracking the child care credit? And from the very first poll, this question sort of answers itself. Is your team confident in responding to retroactive rule changes?
So for those of you who aren't on Greenshades online, you're still using GP Payroll and we are supplementing your tax tables. You know, if you move to Greenshades online, you'll get automatic updates for tax codes, form adjustments, new deduction fields, built-in support for your multi-jurisdiction tip and overtime tracking, configurable rules for benefits eligibility, etc., transparent payroll flows that flag compliance risks before you finalize your pay run, and no per run fees or surprising costs that pop up. We just started you can move to the next slide, LinkedIn Compliance Corner, where we will be posting live updates as we learn them. It'll be a great resource for you guys to follow. I will stick this in, I think I can put it in the chat maybe, but we will also email this to you guys in a follow-up email. And then we will have some information for the IRS Newswire, the quick alerts, forms, publications, H&R Block links for you guys. And then just to thank you. And like I said, there were so many questions that we will follow up with you guys individually on those. And maybe we can even do a blog that covers some of those questions if you guys are interested in what other people were asking. And I can leave this open a little bit longer if anyone else has additional questions to put in the Q&A chat. Oh, thank you for the applause. Great. I'm glad you guys saw some benefit in this thought leadership webinar on compliance.
Danica, will they see on the LinkedIn when we get information from the IRS on final determinations and rules and regulations? Or should they go to Greenshades blog?
We will be posting it in both. We're trying to give you guys multiple resources since we understand not everyone's following our blog or opening our newsletters, and hopefully LinkedIn, if you join this LinkedIn group, you can check it regularly or it'll just show up in your feed when we have new posts. That is kind of the goal of that, is to give you guys multiple resources.
Thank you all for attending.
Yep. Thank you guys. Thank you, Laura. And this will conclude our webinar.
Thank you.